Good morning all. On behalf of KPMG, I'd like to welcome you to the latest webinar in our Tax Leadership series. We continue to be extremely busy on the tax front with a number of local consultations opened in the last couple of months and the release of the OECD Pillar 2 rules, as well as the introduction of the draft EU directive implementing Pillar 2. So 2022 is shaping up to be a decisive year for fundamental reform of the international tax framework. There are many moving parts to this, and indeed certain aspects of the OECD proposals remain to be agreed, particularly around Pillar 1. In addition, the ability of some jurisdictions, most notably the US, to implement these rules at this point is very unclear. But today we're going to focus on the Pillar 2 rules. Further guidance is expected to issue on Pillar 2 in the next couple of months, so I would encourage you to remain engaged with your KPMG teams over the next number of months to understand fully the impact of these rules on your business. But for now, I'm delighted to hand you over to my partners Anna Scally and Cillian Barry, who will talk you through the key elements of the rules as they have been released. They will then be joined by two of our international tax partners, Danielle Rolfe, who's the co-lead of international tax in our Washington National Tax Practice, and Conrad Turley, who's the our lead policy in the ASPAC region. I hope you find the webinar worthwhile, and please do feed any feedback back to us. But for now, Anna, Cillian, over to you.
Many thanks, Tom. Hello and welcome to everyone joining us today. My name is Anna Scally and I will kick off our session. I'm going to take you through where we are in the BEPS 2 process and what we might expect to see in 2022. In addition, I'm going to share with you what we are hearing from companies and touch on some of the key issues that are top of mind for you and other senior tax leaders. My colleague Cillian Barry will then be joined by Conrad Turley to take us through some of the key details of the Global Anti-Base Erosion Measures, or GLOBE, which are essentially the global minimum tax proposals. As Tom mentioned, Conrad is a tax partner with KPMG China and is our Asia-Pacific regional tax policy leader, where he works closely with various government agencies on tax policy developments. Conrad previously worked with the European Commission Tax Directorate in Brussels, as well as KPMG Ireland, the Netherlands and Hong Kong. Cillian will then bring us through some of the key aspects of the EU directive designed to implement the minimum tax proposals in the EU. I will then be joined by our US colleague Danielle Rolfe. Danielle is co-leader of KPMG US's international tax team in our Washington National Tax Practice, where she advises clients on international tax matters. Prior to joining KPMG, Danielle served in the US Treasury Department's Office of Tax Policy as International Tax Counsel, leading Treasury's International Tax Legal Team. Danielle will cover the proposed tax changes in the US, which are incorporated in the Build Back Better Act. Danielle will then take us through those proposals, their likely chance of success, and if they don't pass, what happens next. Towards the end of the session, we will then be rejoined by Cillian and Conrad for a Q&A session. In that regard, please do feel free to ask any questions that you have through the Q&A or chat function. So let's get started. I think it's important to level set on where we are at this point. You'll all recall that BEPS 2 was designed to tackle the thorny issue of taxing the digital economy. This was the great unresolved issue after the BEPS 1 suite of measures were introduced in 2015. The OECD and G20 inclusive framework, which today comprises 141 members, was established to help countries to collaborate together to implement the BEPS measures and to improve the coherence of the international tax rules. The inclusive framework recommended a two-pronged approach to dealing with the BEPS 2 agenda, Pillar 1 and Pillar 2. And while the intent was to deal with taxing the digital economy, Pillar 1 and Pillar 2 now go way beyond digital and potentially cover companies in most sectors. Today, we're focused on Pillar 2 and specifically on the minimum tax rate proposals, Global Anti-Base Erosion Tax, or GLOBE. We're going to cover the concepts outlined in those rules, which will include how to calculate GLOBE and who gets to pick up any top-up tax due through the Income Inclusion Rule, IORR, or the Undertaxed Profits Rule, UTPR, previously known as the undertaxed payments rule. The model rules introduced in late December did not cover Pillar 1 at all, or the subject to tax rule, which will form part of the Pillar 2 framework. They are to follow in 2022. It's important to note that the model rules produced by the OECD are a common approach. This means that they do not have to be implemented by all countries, but where countries implement them, they should follow the model rules. So, what to expect in 2022? The OECD have a fairly aggressive timetable. Guidelines to support the model rules will be introduced in Q1. They will then be followed by the subject to tax rules, which will set out the rules relating to the minimum tax rate that should apply to certain types of payments, like interest and royalties. That will be followed by a consultation, and then those rules are expected to be finalised by the end of 2022. All countries are expected to introduce domestic legislation to give effect to the rules by the end of 2022, and the IRR and STTR are expected to be implemented effective 1 January 2023, with the UTPR coming into effect 1 year later on the 1st of January 2024. It remains to be seen whether this timeline will be followed and if the Jan 2023 implementation date can be achieved. The EU directive, which also issued in December, and Cillian will cover that, follows the OECD model rules very closely and commits all EU member states to implementing the rules effective 1 January 2023. And this is just Pillar 2. For many countries, Pillar 1, which deals with the reallocation of certain super profits to market jurisdictions, is a prerequisite, and both pillars go hand in hand. More work is required on Pillar 1 before we see those model rules, again in 2022. So why does this all matter? Well, here are just a couple of key issues which are top of mind for senior tax leadership in companies both locally and internationally. These proposals will no doubt impact upon the effective tax rate, cash tax and earnings per share of in-scope companies. They will also change tax planning opportunities and the way in which tax risks are assessed. Tax, if it's not already a regular boardroom item, will become front of mind. Indeed, as many of you have just passed your year end, I have no doubt that this will be one of the key items for discussion in finalising your financial statements, with senior management and boards, who will all be really keen to understand the impact on the financials. The model rules follow what's known as a common approach, as I mentioned, and each country is going to have to embed them into their own tax laws. Implementation may not be uniform across all 130 plus countries. Indeed, the timing of implementation may differ too. Also, the transparency regimes under which companies operate may differ, noting that our own Department of Enterprise, Trade and Employment are currently seeking feedback on the transposition of the EU directive on public C/CR. Incentive regimes offered by countries are going to change, and that may have an impact on investment decisions. Tax holidays or significant reductions in tax rates are not going to cut it anymore. Will countries increase grant aid or other subsidies? Internal resources are going to be under huge pressure. As we can see from what Cillian and Conrad are going to take us through, there will be even greater need for cooperation between accounting, finance and tax functions within organisations. Financial reporting systems will need to be reconfigured to capture the data required in a usable format, and additional reporting and tax returns will add significantly to the burden of the tax team. And this will all require extensive modelling to understand the impact that these changes will have on each multinational company and group. And the modelling done in recent times will need to be updated now that we have these model rules. So Cillian, please jump in and take us through more of the detail.
Thanks, Anna. As mentioned, the Globe model rules seek to ensure large in-scope groups pay a 15% minimum rate of tax on the profits arising in each jurisdiction they operate in. The OECD see this as putting a floor on tax competition. The Model Globe rules extend to about 70 pages and are complex in certain regards. For example, the rules contain over 15 different elections which will require detailed consideration by businesses. The OECD intends to release detailed commentary on these rules early this year. The OECD will also address the thorny issue of the coexistence of the US GILTI rules with the Globe rules at that time, which we'll come back to later on. While the overall thrust of these rules is broadly similar to the blueprint released in 2020, there are a number of significant differences, such as how deferred tax is addressed. While over 130 jurisdictions sign up to these rules, as Anna mentioned, they are based on a common approach, and therefore it will be necessary to closely monitor the approach adopted by each jurisdiction. In this regard, KPMG have an online tracker to help keep abreast of local developments. The global rules will apply where the consolidated group revenue exceeds 750 million, based on the consolidated financial statements of the group. Therefore, this remains aligned with the country-by-country reporting threshold. However, the period to test this revenue threshold has changed. It is now necessary that the 750 million revenue threshold is met in 2 of the last 4 years in order for a group to be within the scope of these rules. There are separate rules to address changes to the group, such as mergers and demergers. In the case of a merger, the rule will apply if the aggregate revenue exceeds 750 million euro. There are a number of entities excluded from these rules, so lucky for them, they will not need to delve into the complexities. These include government entities which do not carry on a trade, pension funds, and investment funds and real estate vehicles, but only when they are the ultimate parent entity of a group. This reflects the tax neutral position of such funds. There is also an exclusion for international shipping income, provided certain substance requirements are met. Separate to these rules for excluded entities, there is also a de minimis exclusion, whereby on election, certain small entities within a jurisdiction can fall outside the rules where the revenue in that jurisdiction is less than 10 million and the profit is less than 1 million. Provision is also made to alleviate the impact of these rules during the initial phase of international activity by a group. Where the group has activities in no more than 6 jurisdictions and the net book value of the tangible assets of all entities does not exceed 50 million, ignoring the largest jurisdiction, then the rules may not apply for a period of up to 5 years. A key outstanding item in the Globe rule is that of safe harbours. The safe harbours will operate on an election basis and with the aim of reducing the administrative burden of the rules on certain groups by deeming the top-up tax related to certain jurisdictions to be 0. While the safe harbours are not yet fully developed, one possible approach would be to adopt a simplified effective tax rate calculation by leveraging off the country-by-country reporting information. The safe harbour rules are clearly eagerly awaited. Now, moving to the next slide, this slide sets out the order of priority of applying the top-up to achieve the global minimum tax rate. While the subject to tax rule would apply firstly, we have not included it here given the proposed narrower scope and that those rules are not yet developed. If the ETR calculated under the Globe rules within a jurisdiction is below 15% and therefore a top-up tax arises, the first opportunity to collect this tax is given to that jurisdiction. This is called the domestic top-up tax and allows that jurisdiction to collect an additional tax to ensure that a 15% ETR is achieved. If a jurisdiction does not apply a domestic top-up tax or it is insufficient, it's then necessary to consider the income inclusion rule. The income inclusion rule is a top-down approach, and therefore if the ultimate parent is in a jurisdiction which applies a qualifying income exclusion rule, then that jurisdiction should collect the top-up tax. If the ultimate parent's jurisdiction does not apply the IR, then it's necessary to consider if the IR drops down to an intermediate parent entity. Finally, if the IR does not apply or it's insufficient, then the backstop rule applies, the UTPR. As Anna mentioned, this did mean the undertaxed payment rule, but given the changes to how this rule operates from the blueprint, it now seems to have morphed into the more appropriate undertaxed profits rule. The UTPR could operate via the denial of a deduction, deeming of taxable income, or indeed the imposition of an additional tax. Importantly, the UTPR is no longer limited to related party payments only, but is now extended to cover all tax-deductible payments. The UTPR is allocated to all UTPR jurisdictions using an allocation key, which is based on the number of employees and the value of tangible assets in each UTPR jurisdiction. This rather crude method ignores value creation and key functions and could result in larger allocation to jurisdictions housing more routine functions. However, given the UTPR is the backstop, it may not widely apply in practice. And with that, I'll now hand over to Conrad to discuss the Globe model rules in more detail.
Thanks, Killian. So Killian has brought us through the rules around the imposition of the top-up tax, including the IAR and the UTPR. In my section, I'm going to focus now on the calculation of the top-up tax. And at the core of that is the calculation and determination of the effective tax rate. And in making my remarks, I'll be referring, as Killian has done, to the October 2020 blueprint, which many of you may have read, as there's been a number of important changes in the model rules from that blueprint. So to start with, at point 1, we have the globe income determination. That's the globe income for a jurisdiction. And this is the denominator in the ETR calculation. That's covered by Chapter 3 of the model rules. So what you need to do is you need to aggregate the income and losses of constituent entities of the multinational in that jurisdiction and make a number of adjustments for permanent differences and other items that I'll get to on a subsequent slide. As a second step, you need to determine the covered taxes. This is the ETR numerator, and it's covered in Chapter 4 of the model rules. And this takes the various income taxes paid by the group and undertakes a major exercise on attributing them to the correct jurisdictions as required by the rules. In addition to bringing in, and this is probably one of the most complex features of the rules, deferred taxation adjustments. And this is to deal with timing differences, as I'll explain subsequently. Moving on from that, you come to the calculation of the jurisdictional effective tax rate. And this is the basis for calculating the top-up tax in a jurisdiction. And I would notice, and Killian has referred to this earlier, that a key matter for attention in 2022 will be the development of the safe harbors. And Killian made reference to a safe harbor based on CBCR data. Now, this was in development in the blueprint. We have yet to see what direction the OECD bring that in. But what this would do is it would allow a multinational to make reference to the fact that it's got a high level of ETR in particular jurisdictions based on the CBCR data and avoid having to do the full complex ETR calculations. So the final scope of that safe harbor and its design will be very important to multinational groups to see whether they can avoid having to do the full calculations and maybe help them determine to what extent they need to make investments in their systems to deal with these processes. Another important point to make in relation to this point 3 on jurisdictional ETR is that it is a jurisdictional calculation. So it's what we call jurisdictional blending. And if a group has high taxed entities and low taxed entities within a jurisdiction, then it can potentially use the high tax of some entities to protect incentives in the other entities. And in an Asia Pacific context, this has received a lot of attention because you may have countries with rather diversified economies, large economies, where multinationals will have both high and low taxed entities. China would be a very good example in that regard, where jurisdictional blending may in practice be effective to protect a lot of tax incentives. And by contrast, you have jurisdictions where there's maybe one type of activity done by a multinational, let us say manufacturing activity in Vietnam. There may be no other multinational activities there, so nothing else to protect the incentives received by Vietnamese manufacturing entities. So that's an important consideration for planning going ahead. Moving to step 5 on determining the excess profits. This is determined by taking the globe income and reducing it by the substance carve out, which is a routine return on substantive activities that I'll return to on a later slide. And following that, we come to the calculation of the jurisdictional top-up tax, which is the top-up tax rate as calculated earlier, multiplied by the excess profit. Now, at this stage, there is an offset for the domestic top-up tax, if it is a qualified domestic top-up tax. And what we mean by this is a domestic top-up tax, the design of which has regard to the Pillar 2 rules, these globe rules on tax-based determination. And essentially what the OECD is saying is that it's giving jurisdictions a final chance to take the taxing rights in respect to entities resident in their jurisdiction before they're handed on to other jurisdictions through the IAR and the UTPR. And certainly this has attracted a lot of attention. This feature of the rules has been given much more prominence in the model rules than was the case in the blueprint. And to take the Asia context, you've got jurisdictions like Singapore, Hong Kong, Indonesia, all talking about potentially going down this road. So a matter that's quite important. As a final point on the slide, what I would say is, before you apply the IAR and the UTPR, you take the top-up tax for the jurisdiction and allocate it over the entities in the jurisdiction in the ratio of their globe income. And consequently, what can happen is you can have high taxed entities within the jurisdiction that are attributed part of this top-up tax. And this can have implications where you have minority investors outside the group with holdings in those low taxed entities. They're wondering why they should be suffering part of the group's top-up tax when they're invested in high taxed entities. And that's also a question that's coming to the fore in an Asian context. So this slide may seem a bit intimidating, and nearly rightly so, because this gets to the core of the Pillar 2 rules and why it's so complex. At the bottom of the screen, we have the globe income. That's the denominator for the ETR calculation. And as per the blueprint, the starting part is the financial statements of individual entities within the group. Now, they need to be adjusted in the direction of the parent gap, the parent of the group, but the OECD make the assumption that this will happen as part of the consolidation process. Now, there are a number of permanent difference changes, so the removal of non-portfolio dividend income and gains on disposal of non-portfolio equity holdings. There's also many complex rules to deal with in relation to hybrid financial arrangements, adjustments or safeguards there, and special elections that can affect this globe income number, such as removing fair value movements on immovable property until realized where an election is made. But the really tricky part is the covered taxes, the numerator. So to start with, and to give you an idea of some of the complexity here, in the blueprint, the starting point was taxes paid. That's the numbers in the tax return. The model rule goes in a different direction and starts with the current tax expense in the financial statements. And consequently, there's a need to take out taxes relating to uncertain tax positions on the basis that they reflect management judgment and could be susceptible to manipulation. There's also a safeguard in relation to accrued taxes that never actually get paid. So if you have taxes that are accrued but not paid within 3 years, they need to be adjusted out. Moving on is the matter of the attribution of covered taxes. And to give you an example, withholding taxes on interest and royalties, well, they'll be attributed to the recipient of those income, whereas withholding tax on dividends, and indeed tax on dividends at the level of a recipient, is attributed to the payer instead. So you can see different rules of attribution for different types of withholding tax even. There's allocations to permanent establishments under complex rules, and maybe even more complex than that, the allocations of CFC taxation to entities. And we'll probably get to this point later on in the presentation, but if, for example, the US GILTI regime were not to be considered a qualified IIR, then potentially that would also be allocated under these provisions. Another important feature of the rules is that there are various trigger events in relation to the recalculation of prior year ETRs. So you may need to reopen prior year calculations. And as noted on the slide, one such event is a prior year adjustment that leads to a material decrease in the tax for that year. Another one would be where the taxes accrued are not paid within 3 years. Another can arise in relation to this election to disregard fair value movements on immovable properties that are later disposed of. Other cases can be in relation to deferred tax provisions. Now, this additional top-up tax is payable in the current year, so we're not talking about needing to have refunds or extra tax payments in relation to prior years, but nonetheless, you need to do a recalculation and recalculation of intervening years. And so it's going to make it a very challenging compliance process requiring automation in many cases. And this is even before getting to deferred tax, which appears to be the most complex part of the covered taxes determination. And the idea behind deferred tax is that distortions to the ETR number from book to tax differences can be dealt with by including a deferred tax number in the ETR numerator. And it should be noted that this is also the OECD's chosen approach to dealing with carry forward tax losses. Now, fortunately, there's no time limit restriction in relation to pre-regime carry forward tax losses or in relation to using in-regime losses. That was a concern at the time the blueprint came out. I should note at the outset that we're not simply talking about taking up the deferred tax numbers in the accounts and using them. The accounting numbers are simply a starting point for getting to an adjusted number. So to start with, any valuation allowances made in respect to deferred tax assets, they'll need to be reversed out. Furthermore, many deferred tax liability items will need to be tracked to see if they reverse within a 5-year period. So on the left-hand side, you'll see a list of items for which the 5-year recapture rule for deferred tax liabilities won't apply. So that helps to a certain degree, but this leaves items such as intangibles that could be caught. And to give an example, let's say there was a deferred tax liability calculated with respect to an intangible and it reverses over a 6-year period. Well, then it shouldn't be included in the ETR numerator, and this means higher top-up tax. If it were to be included and it was later found that it hadn't reversed within 5 years, then retroactive adjustments would need to be made to the ETR and the top-up tax. So you can imagine how complex that would get. An issue arises, and this has attracted a lot of attention, including in Asia Pacific, is the requirement to recast deferred tax items where they're computed at a rate higher than 15% at the 15% minimum rate. And as you can see from the illustration here, where in a jurisdiction, a multinational has both permanent and temporary differences, the 15% recasting effect can create an additional top-up tax burden. And that's even though the ETR is high over time. So in this example, the statutory tax rate is 25%, the accounting ETR is above 18%, and even so, the globe ETR gets dragged under 15% due to this recasting, resulting in top-up tax. Now, it's not known whether there'll be any further adjustment made to the model rules to deal with this, as it seems to not be entirely consistent with the policy objectives of Pillar 2. However, as we understand it, the rules released on the 20th of December were meant to be the final rules, so perhaps no adjustment will be made for this, but this has been raised by business groupings with the OECD. There are many elections to be made. This will be a complex matter for groups to work through. Some elections for 5 years, some annual, some once off. And what it can be said quite simply is that companies will be facing a trade-off between optimizing their tax position and reducing their compliance in making these elections. I mentioned before that in calculating the excess profits to which the top-up tax rate is applied, you can reduce it by a substance-based income inclusion. And this reflects a kind of routine return on substantive activities. So you have payroll, which is quite generously defined. It can include independent contractors and various different cost structures, employee benefits, employee share schemes, social security contributions in the base. You take a markup on that of 10%, and that markup reduces the excess profits subject to top-up tax. Now that declines over time to 5%, but that's over a 10-year period. Tangible assets, there's a markup of 8%, and similarly that declines to 5% over 10 years. And what this can do effectively is, to the extent the profits in a jurisdiction are relatively modest, a routine return, this substance-based exclusion could potentially lift the entire profits out of the scope of the Pillar 2 tax. But if there are very substantive profits in a jurisdiction reflecting intangibles, reflecting synergies or other high levels of residual profits, then this may only go part of the way to protecting you. So Killian, with that, I'll hand back over to you.
The EU has certainly been very active in putting forward tax policy proposals, and I want to firstly briefly mention two other EU developments. The directive on public country-by-country reporting entered into force last December and must be transposed into domestic law in each member state by June 2023. In December, the EU also released a proposed directive targeting the misuse of shell entities, seeking to ensure that entities in the EU that don't meet certain minimum substance requirements are unable to benefit from any tax advantages. But turning back to the minimum tax rules, following quickly on the heels of the OECD release, on the 22nd of December, the European Commission released its proposed directive to implement a 15% minimum tax rate within the EU. It is this directive which will ultimately need to be transposed into Irish domestic law if fully ratified. The stated aim of this directive is to ensure a coherent and consistent implementation of the OECD proposals within the EU, and in addition to ensure the rules are compatible with EU law. Helpfully, the proposed directive is consistent with the OECD proposals and aims to remain as close as possible to the model rules. However, there is one fundamental difference whereby the EU rules will also apply to large-scale, purely domestic groups. This is required to ensure the rules are compatible with the freedom of establishment and avoids the risk of any discrimination in a member state between groups with cross-border activities and those with purely domestic activities. As this is a directive in the field of direct taxation, unanimous approval within the EU will be required. Most EU states are part of the OECD process, and while they have agreed to the OECD proposals, there is no doubt that there are conditions attached to certain jurisdictions signing up. Cyprus is the only member state not participating in the OECD process, although they have stated that they are aligned with the OECD BEPS 2 proposals. Similar to the OECD model rules, the directive provides for a top-up tax information return to be filed. Where this return is not filed, the directive states that a penalty equal to 5% of turnover can apply. One final difference of note is the application of the transition rules to intragroup transfers. The OECD applies these rules to transfers from 30 November 2021 to the transition year, while the EU rules apply transfers after 15 December 2021. These transitional measures are expected to apply throughout 2022 and will require consideration for those companies considering intragroup asset transfers or other restructurings during this period. France holds the presidency of the EU for the first 6 months of 2022, and one of their stated aims is to introduce this directive within that period. However, the Commission acknowledges that the effectiveness and fairness of these proposals rely heavily on their worldwide implementation, and it is vital that all major trading partners introduce equivalent rules. On the topic of major trading partners, I'll hand back to Anna now to discuss the position in the US.
Thanks, Cillian and Conrad. Danielle, we've had major tax reform in 2018, and we were all expecting major tax reform again under the Biden administration. But the Build Back Better Act appears to have stalled at the Senate and may not be as radical in some respects as we may have expected. There are, however, some very important and key provisions in that Build Back Better Act which would align the US regime with these new OECD proposals. Can you take us through the key provisions of the Act that are relevant to international businesses?
Thank you, Anna. And I focus here on 5 of those key provisions. The first, which is really a domestic proposal, not an international one, but obviously essential, is the rate. And I think we're surprised that the provisions have come to rest with no change to the domestic rate, with the rate holding at 21%. But ultimately, that is what was needed to buy the vote of one essential senator. So we have the corporate rate holding at 21%, but in order to sort of shore up the revenue that would have been raised by an increase to the corporate rate, the bill would introduce a new 15% alternative minimum tax where the global profits for an MNE exceed 1 billion. This is novel. The US traditionally resists having tax proposals that turn on book results, but this new 15% AMT would be imposed based on book income. I think it's important here to distinguish this proposal from the qualified domestic top-up taxes we just heard. The base here is quite different. This is book income of both the US and any foreign subsidiaries or foreign branches, taken together with very few adjustments to that book income. So moving now to the international proposals, there are quite a number of changes proposed to the US BEAT regime. I highlight just a few of the key ones here. The bill, first and maybe most significantly, would increase the BEAT rate. It does so gradually over time. So the BEAT rate today is 10%. It would step up to 12.5% for tax years beginning in 2023, 15% for tax years beginning in 2024, and would top out at 18% for years that begin in 2025. Probably the next most significant change is that they would expand the BEAT to cover cost of goods sold. So this is really important because today a number of companies that are doing business abroad, for example, in Ireland, can avoid the BEAT altogether if they're purchasing inventory from an Irish affiliate or otherwise paying amounts that will be capitalized into inventory costs. This proposal would eliminate that exception and only allow a now very narrow exception for cost of goods sold that can be retraced to unrelated party payments. The next, that I think that brings out this next third most important point in the BEAT, which is that they would add a new exception for income that meets an effective tax rate test. So first, under this new exception, if the income is subject to GILTI, the taxpayer would be completely done. So for US parented multinationals where their foreign subsidiaries are generally subject to the GILTI regime, this essentially turns BEAT off and really would make it just an inbound proposal. For foreign parented groups, this new effective tax rate test means that if the foreign rate exceeds the BEAT rate that is in effect for that year, so you saw that I have the BEAT rates phasing in over a number of years. If the foreign effective tax rate on the income exceeds the BEAT rate for that relevant year, then the deduction is not required to be added back under the BEAT regime. Fortunately, that rate test tops out at 15% rather than stepping all the way up to 18% in 2025. Presumably, this is to conform to the 15% rate in Model 2. One important point, we don't really have any guidance on how that effective tax rate would be computed, but we do assume there's enough authority there that Treasury has at least the potential to conform that computation to the model Pillar 2 rules. The next change called out on this slide is a new interest limitation rule. It's important to point out that this rule would apply to both inbound companies investing in the US, as well as to US parented groups. And it would deny interest when the US entities are viewed as excessively leveraged based on either the amount of earnings that are booked in the US versus the rest of the world, or the amount of assets in the US versus the rest of the world. Fourth on this slide is the changes to the GILTI regime. So most significantly for this discussion, the BBBA would change GILTI so that it would apply on a per country basis, and it would increase the rate above 15%. Those are the 2 points that are generally considered essential for GILTI coexistence, in particular per the EU directive. There are a number of other changes, in fact, that would raise the US ETR on GILTI to actually 15.015% as called out on the slide. But I think it's also important to point out that they retain the haircut on the amount of foreign tax credits that are allowed. Under current law, foreign tax credits are haircut so that a company only gets 80% of the foreign taxes that they pay as a credit. Under this proposal, the haircut is reduced to 5%, but it's still a haircut. So that means the hurdle rate to not owe US GILTI isn't that 15.015%. It's actually 15.8% that you would have to pay in foreign taxes to not owe any GILTI at all. Last but not least, I should say they do retain the exemption for qualified business asset investment, similar to the tangible asset exception under the Pillar 2 rules. However, in this revision, it would only be 5% exception for QBI, effective immediately. Finally, last but not least, the proposals would retain the FDII regime, and it would increase the effective rate to 15.792%. So they essentially retain the parity with the post foreign tax credit GILTI regime.
Great, thanks Danielle. So what are the chances of the Build Back Better Act being enacted or being passed by the Senate? Specifically, the US White House pushed strongly for both Pillar 1 and Pillar 2 changes. Will the US reach agreement and implement changes to GILTI and BEAT?
Oh, that's a really hard question. As you know, our US government at this moment is very closely divided. In order for the Democrats, this is a partisan piece of legislation. In order for the Democrats to pass the Build Back Better Act, they need all 50 Democrats in the Senate to go along. In December, it became clear that they do not have all 50 Democrats. Senator Manchin from West Virginia has said he cannot vote for the bill in its current form. In particular, his objections relate to the spending side of the bill. It's important to note he has not raised concerns on the international tax provisions that I just reviewed. At this moment, the negotiations on the bill have largely been suspended. They've described it, I think, in the media as a cooling off period, but it isn't dead. I think they ran out of time in 2021, and I think the negotiations are really hard. It's at this moment not clear what the timetable is for them to come back to, negotiating in the public eye on the Build Back Better Act. And it's really not clear at all if they're going to be able to get this across the finish line. In fact, it's tough. I think you've got people that would guess they succeed and folks that are betting that they don't succeed in getting across the finish line. I think the key point for this audience to understand is that the current objections to the bill don't relate generally to the international tax provisions. In particular, there appears to be agreement on the GILTI changes and the changes to BEAT, which are, really essential for getting the US to at least be viewed as going along with Pillar 2. And I think that if any version of the Build Back Better Act passes, including, I think there is still a very meaningful chance that a slimmed down version would pass. I do believe the international provisions with respect to GILTI and BEAT at least would be a part of that. I should probably note that the changes to the interest limitations that I highlighted, as well as that book minimum tax, I think are on much shakier ground. So their prospects, are more uncertain than the changes for GILTI and BEAT.
Pillar 1 and Pillar 2 are considered a package deal by many jurisdictions. And there's no mention of Pillar 1 in the Build Back Better Act. How will the US implement Pillar 1, or how would they implement Pillar 1? And what's the likelihood of it being enacted?
The prospects for enactment of Pillar 1 in the US have always been extremely uncertain. Ratification of a treaty in the US requires 2/3 of senators, so that's 67. And as I mentioned, they're struggling right now to get 50 votes for the BBBA. Many Republicans have publicly raised concerns with the US Treasury's negotiating position at the OECD, so that at this moment, Pillar 1 is a partisan issue in the US. And that's despite the fact that key Republican leaders did sign a letter a couple of years ago indicating that multilateral negotiation at the OECD was the right way to deal with the pressures raised by the digital economy. There are a few paths that would require fewer than a 2/3 vote, and these have been talked about at great length. There is the possibility of a process that's been used for some trade agreements, which only requires 60 votes. And some have even talked about paths to enactment that would only require 50, but that possibility would raise serious questions. I think the more important point is, for me, it's really hard to see Democrats taking this on in an election year, which we are now in, on a completely partisan basis. So I think that means that for Pillar 1 to happen in the US, it will probably need to be with at least some Republican support, which means that it can't lose revenue and that a critical mass of companies would need to support it because they believe it will buy stability and is better than the alternative, a proliferation of more unilateral measures. At this moment, it's not looking very good on that front. I don't think that businesses have really gotten behind, I think there are certainly exceptions to that, but I think there are a number of companies that are still lobbying senators to say this is not a good idea.
So Conrad, maybe I could turn to you. What are the wider implications if a major jurisdiction such as the US or even a country like China doesn't implement both Pillar 1 and Pillar 2 proposals? Will the BEPS process fail if either of the pillars aren't enacted?
Well, Anna, that's another very challenging question to which, honestly, there's no clear answer at the moment. I think, to be honest, up until quite recently, most people in business as well as in government were kind of thinking of outcomes in terms of either the process works out, the rules are passed into legislation and looking kind of at the technical issues, or at the other extreme, the entire process collapses and there's no BEPS 2 rollout. But now that we've got to the point where there was the agreement in October and the release of the detailed Pillar 2 rules, and the process does have this momentum, but there are these questions, and Daniel went through them in detail, on the position of the US and whether it can get either the Pillar 1 or Pillar 2 related changes to GILTI through. There's an increasing assessment, including in Asia Pacific, about what different countries might do in different scenarios. And it must be said at the outset that in Asia Pacific, most of the countries have not said what they would do in different contingencies. So, for example, what would happen if the US does not succeed in making the GILTI changes related to Pillar 2, but the EU forges ahead with its Pillar 2 directive and then implements IIR and UTPR? What would the Asian Pacific countries do? I mean, for example, for a jurisdiction like China, clearly it wants to protect its multinationals from being hit by the UTPR. That's one incentive for it to go ahead and implement IIR, as is the case for other jurisdictions. But would they go to that degree? It would remain to be seen. If, let's say, the US didn't make the GILTI changes and the EU couldn't move ahead either, well, I think other jurisdictions would probably assume that there was no value in moving ahead with Pillar 2 at all. For Pillar 1, some jurisdictions have said they see Pillar 1 and 2 very much tied together. Others, even in some instances privately more than publicly, would say they would be okay for Pillar 2 to move ahead, at least at an accelerated time frame relative to Pillar 1. But what would happen then if the US can't get Pillar 1 through, the EU reverts to its digital levy? What will their stance be? There's a lot of uncertainties now, and I think certainly within KPMG at global level, and also in various multinational groups, there's a look now at different scenario planning. What would the group expect the tax environment to be under different scenarios, and how could they deal with them?
Thanks, Conrad. And Cillian, will the EU directive go ahead if the US cannot implement?
And we're certainly getting very difficult questions on implementation today. There's no doubt that the European Commission and the large countries such as France and Germany are very eager to introduce these rules. And I mentioned that the French presidency of the EU at the moment, and they're seeking to introduce the directive in the first half of this year. However, there are likely to be many obstacles to this, and in particular, a number of smaller countries in the EU are likely to insist that wider worldwide adoption must take place at the same time. In this regard, the position in the US that Danielle discussed here is key. The progress of Pillar 1 will also definitely be important for a number of jurisdictions, as both pillars remain a package in the eyes of many. Indeed, some concerns were raised at ECOFIN just this week, and it remains to be seen if those concerns can be addressed by the EU. Ultimately, the Biden administration have been a major force in driving these proposals, and if the US can't implement them, it definitely will place a significant barrier on introducing these rules in the EU.
So how will Ireland implement these measures and continue to compete internationally?
Well, Anna, as we know, Minister Donoghue confirmed in October that Ireland had signed up to the OECD BEPS 2 process following the commitment that the minimum rate would be capped at 15%. And in addition to implementing an income inclusion rule for Irish headquartered groups, we can expect that Ireland, like most other jurisdictions, would adopt a domestic top-up tax if the European directive is approved. And this would ensure that any additional top-up tax due in respect of companies located in Ireland would be collected by the Irish government and not by the ultimate parent jurisdiction entity. This will impact both Irish headquartered groups, which is estimated to be between 50 and 60 groups, and Irish subsidiaries of foreign multinationals, and that's estimated to be approximately 1,500. I would say that importantly, the 15.5% tax rate will continue to apply to groups which are not within the scope of these rules. The Minister, in his statement, he committed that Ireland would remain competitive and that we would have a best-in-class approach to attracting investment. I think adopting a 15% rate ensures that Ireland retains the lowest possible tax rate for groups that are within the scope of GLOBE. And in addition, incentives such as the R&D tax credit regime can continue, and Ireland will ensure that the R&D regime is considered a qualified refundable tax credit under the GLOBE rules. However, I think it is important for Ireland that we remain competitive in other areas, and I think investing in education and skills and infrastructure while promoting innovation will be important going forward as well.
Conrad, can I turn to you for a moment? While many jurisdictions have high headline rates of tax, we know that the effective rate can be much lower through the use of various incentives and tax holidays. How will these rules impact such jurisdictions, and how do we expect countries to respond?
That's an extremely good question, and in discussions with tax directors within Asia Pacific, this is a question that's very much to the fore at the moment. As I mentioned in my earlier remarks, a key influence on whether incentives are impacted is jurisdictional blending. I gave the example before of a group with operations in China, high taxed entities, low taxed entities. Whether their incentives are ultimately impacted would be a function of whether their high taxed entities through jurisdictional blending could protect their low taxed entities. In other jurisdictions where they have more homogenous activities, let's say they solely have manufacturing, it's incentivized, there's no blending possible, then they may be more exposed. Another consideration is this substance exclusion, obviously. And again, the circumstance can differ by jurisdiction. Let us say we're talking about Vietnam, and a routine return is allocated to the manufacturing there. It could be the substance exclusion is enough to protect the limited profits booked in the jurisdiction. Whereas let's say you have a Singaporean principal within your group with significant residual profits, that substance exclusion may be insufficient. Now, there's been a lot of talk in Asia Pacific about the move to grants and subsidies. And there is a lot of enthusiasm to see movement in that direction. At the same time, there's an awareness that the OECD has picked up on this, and that to the extent that a jurisdiction would look to compensate a company affected by the Pillar 2 rules with grants and subsidies kind of calculated in the same way, then that could disqualify that jurisdiction's IIR or UTPR as being qualified under the rules with all sorts of negative knock-on effects. So there is a consciousness of that. Another point I would make is that there's a look at to what extent jurisdictions may already be moving to claw back tax incentives at an administrative level. So, for example, we have Asian jurisdictions where the tax authorities are approaching multinationals and saying, look, we granted you a tax holiday for X number of years, but looking ahead, that's not going to be of any use to you. Would you stop claiming it, even though you have a legal right to claim it? So things are already on the move. And I suppose that the final point I would make on this is that there is a reassessment going on in many of the jurisdictions on what tax incentives will truly be effective post BEPS 2, to the extent it does actually go into effect. There are certain types of tax incentives that are better treated under the rules than others. So, for example, accelerated tax depreciation through the deferred tax provisions can be protected to a certain degree. There's a certain preferential treatment given to employee share scheme deductions, whereas something like a super deduction or a tax holiday is more exposed. So what we may see, certainly within the ASPAC region, is a greater conformity in tax incentives to the ones that survive the exposures under the GLOBE rules.
Thanks, Conrad. Final quick question to Danielle and Cillian. Firstly, Danielle, why would future foreign direct investment come to Ireland?
Well, is 15% the new 12.5%? It's rumored that even Puerto Rico, a US territory that because of its tax-friendly regime has been very attractive to pharmaceutical companies, is exploring 15% after new US foreign tax credit regulations took aim at its existing tax regime. Certainly if Build Back Better Act passes, with or without Pillar 2, it would be very hard for US companies to get below 15%. So I do think a 15% rate in Ireland would leave Ireland as a very competitive tax jurisdiction.
Great, and Killian, what do you think?
I fully agree with Danielle. I think, Anna, certainly talking to clients, these rules have been in the offing for a while now. Certainly haven't seen any diminishment in Ireland looking as an attractive jurisdiction. I would say that we will make the changes that are necessary to our regime, especially in relation to R&D tax credits, etc., to ensure they comply. And the government and the minister has committed to maintaining a best-in-class regime in Ireland. And one example of that, I think, is the open consultation running at the moment in relation to moving to a territoriality regime in Ireland for foreign dividends. I think when you add in things like if we're still in the EU, access to the Eurozone, availability of talent and skills and workforce, all these will continue to make Ireland an attractive jurisdiction, and I think more attractive than our other competitors in this space.
Thanks, Killian. So to finish, let me summarise a few key takeaways. This is going to have a material impact on in-scope companies, and it's something that all of the tax leaders on this call will be required to discuss with their CEO, other members of your senior management team and your board. And those discussions start now if they haven't already started. Additional resources are going to be needed, both within the tax team and beyond, to deal with the systems changes and the additional information and tax filing requirements. Countries are not necessarily going to implement the rules in a seamless and consistent manner, so it will be necessary to stay on top of all of the changes. Our KPMG digital tracker, mentioned by Killian earlier, KPMG's Tax Watch, and the other resources that we have online should be useful aids to help you navigate the changes. And countries are going to compete in different ways for FDI. I'm very glad that Danielle and Killian agreed that Ireland will continue to be a great place for international companies to invest, and I agree with both of them. We look forward to working with many of you to help you to navigate your way through these complex changes. For those who submitted questions today that we didn't get to, thank you for doing so, and we will be in touch. Or please feel free to reach out to your KPMG contact directly. Many thanks to Killian here locally and to our international speakers, Danielle and Conrad. And a huge thank you to all of you for joining us today. We look forward to speaking with you all again soon. Thank you.